Well, thank you so much for joining today for this video on the pros and cons of a loan modification in North Carolina. Now, you know what? If you've missed some mortgage payments and you're at risk of losing your home, unless you explore options like loan modifications. Loan modification allows you to work with your lender to change the mortgage structure so that it can be considered current by the lender. When your mortgage starts to feel like a heavy load, and a loan modification really provide a much needed breather. North Carolina homeowners face foreclosures. That you have options, but it helps to understand exactly what it means, how it works, and what are the rules in North Carolina that apply to it. Now, loan modification, it really changes the terms of your existing mortgage. It's a way to sort of get back on track if you've missed some payments, or you've lost some income, or you got a financial bump in the road. It's instead of refinancing or starting all over with a brand new loan, a modification adjusts what you already have. Now, the main goal is to change the terms of the existing loan to relieve you of having to pay the arrears immediately, you know, in a manner that is also acceptable to a lender, so that you have a better shot to keep your home. And this can mean, making the amount of arrears like as a second mortgage added on to the end of the first mortgage, but it doesn't have to be paid until the first mortgage is completely paid off. Or it could be that just extending the term of the loan, which can have a positive effect on your monthly payment. Or it could be if you have an adjustable rate mortgage, they might agree to change it to a fixed rate, which causes your interest rates and your payments to be consistent throughout the whole period of the loan. Lenders sometimes call this what they call a workout, or another term that you'll hear is loss mitigation. You know, it's not just a charity that they're doing, because modifying the loan is usually cheaper for them than going through with a foreclosure, which can be quite expensive. Now, be aware that not everyone who wants a loan modification is going to qualify. Lenders look at the entire situation and they set requirements. And they have set requirements. Now, in North Carolina, uh, you often need to meet these basic criteria. So one of them is they're going to ask you for a hardship letter, which is really just an explanation proving that 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 you've either the reason that you fell behind because, hey, you had a job loss, a job change, or maybe you went through a divorce, or maybe there was someone in the family, there was an illness, and maybe some of your hospital costs or medical bills went up. So these kind of things can cause a setback, and just make it hard for temporarily to be able to make those mortgage payments. Um, Another thing is you're going to have to provide income documentation, because lenders, they want to know that you have a consistent, steady, and enough income to be able to handle the payment plan that they will set up for you. Another thing, which is very uncommon, but uh, usually a loan modification only applies to your primary residence. If you actually have a second home that you get in trouble on and you can't keep up on payments, then most lenders are not going to consider a loan modification for a second home. And then they're going to look at your payment history. They're going to look at your credit report. They're going to look at, yes, you've missed some payments here recently, tied to your reasons in your hardship letter that you explained. Um, but they want to show that historically that you have been a consistent payer of your debts. And then there's a lot of paperwork. You have to share your tax returns, your pay stubs, your bank statements, and your hardship letter. And you don't only have to provide those one time, because throughout the whole period where you're being evaluated to qualify for the loan modification, it's probably going to extend over a 30-day period. So you're going to have to be prepared, and it's wise to prepare to provide things like the change on a monthly basis, your credit card statements, bank statements, of course, your tax returns and your pay stubs. All that's going to have to stay current in their file until you have been approved or denied. So be prepared to stay current and proactive on that. Banks, they might have extra rules based on a specific mortgage type or what their individual policies are. The whole process, I tell you, it moves slowly. So you're going to have to be stay persistent and patient, and like I said, keep your documents current with your lender so that you can get through the process as rapidly as possible. Now, there's some common types of loan modifications. It's not like a one size fits all, but the most common types of homeowners for types of modifications for homeowners in North Carolina are sometimes, and I say this cautiously, there could be a change in your interest rate. Okay, it could go up. More likely to go up or stay the same currently than to go down. But historically, there has been times when lenders have um, lowered interest rates, which has an effect on your monthly payment. But if you want to consider the situation where we are today, is you know several years ago the interest rates dropped very low, so there's a lot of mortgages, and you may be one of them that are in that 2% to 4% range, which is extremely low historically. And now interest rates are 7.5, closing in on eight percentage points. And so if you think about it from a lender's perspective, if you already have a low interest rate and your payments are low compared to what they would be today if you refinanced, it's not likely that they're going to lower the rates from a 2 or 3% down to a 1%. So you just have to be realistic about it. The current economic and financial markets are not such that you can expect to get a lower interest rate. But what I do see is they do sometimes extend the term or the number of years your mortgage payments are spread out over. So typically, your home mortgage is for 30 years, 360 months. Well, there are times where I'm seeing now lenders are going to say, okay, we're going to change the term. We're going to lengthen it out further to 40 years. And that does have a tendency to lower your payments. It's spread out over more time, but it does have a significant impact on the total amount that you will pay for the house over that 40 years. If you saw an amortization schedule, you'd be amazed at how much you end up paying for your home when it's all completely paid off. Another thing that they do is possibly principal forbearance, where they might take a portion of your unpaid balance and set it aside temporarily that you can pay off at a later date. You have to be very careful of that because when that forbearance period is over, that amount is due. So you have to have it. That has in itself has caused a lot of people during the COVID time when banks were giving forbearances readily, and lenders, homeowners were taking them readily, even sometimes when they didn't need them. And then all of a sudden, the forbearance period ran out, and all of a sudden, all that money that they were saving that they weren't paying on their mortgage was due. And unfortunately, people didn't stock that money away and save it to pay off the forbearance at the end of the period. They spent it on other things, so they didn't have it, and they weren't able to catch up. Threw them into foreclosure. They have something called a repayment plan. If you have when you work out your budget, if you actually have a decent amount of money left over in your budget every month to the where you could actually put more towards your mortgage, then your lender will instead of making you pay all of the missed payments up front, they'll work out a payment plan where you can pay a little bit extra each month, and it'll go towards catching your missed payments up. And then sometimes they'll convert your mortgage. If you happen to be one of the people that have a adjustable rate mortgage, then they will maybe consider changing that to a fixed rate mortgage that can have a good significant impact and something you can count on. Your mortgage payments won't fluctuate over time. Each option has its own benefits and its own drawbacks, like anything in life. So what works for one homeowner, it may not be a fit for another. So knowing these terms that we just reviewed over can help you ask better questions when you're talking to your lender, and just sort of help you to learn the vernacular or the terms in the mortgage world. Loan modifications, they can certainly be complicated at first, but plain and honest information helps you really take control of the whole process. Now, there are advantages to doing a loan modification when you're in foreclosure here in North Carolina. Loan modifications, they really offer some hope to homeowners in North Carolina. It's you know, it isn't just about the paperwork or the number crunching. It's about keeping your home, easing your financial strain, and opening doors to recovery. So let's look at some of what the advantages are if you choose to go down this path of a loan modification. Stop first of all, stopping the foreclosure is the top reason many pursue the loan modification. This process can put the brakes on a foreclosure clock, buying you time and a peace of mind. When a modification is approved, lenders usually pause or cancel the foreclosure altogether. Most people want to stay in their home, so a loan modification can help make that happen by allowing you to stay put instead of having to pack everything up and move. It can prevent, the forcing your home to be sold and you getting evicted from your home. And it gives you securing your place in the neighborhood. You've got neighbors and friends that you enjoy being around, hopefully. And it also keeps your children in the same school system and in the same routine. Losing a home to foreclosure, it often means more than just a loss of an address or a loss of a box that you live in. It disrupts life and in 100 small ways. And a modification, it really can help you to avoid all that upheaval. Um, Now, choosing a loan modification, it does usually hurt your credit some, but it's really less than going through a complete foreclosure. While you might see a dip in your credit score going through the process, the damage is nothing compared to what kind of credit ding it is if your home gets sold in a foreclosure sale. Now, if you lose your home, your credit will carry the. If you lose your home in a foreclosure, it stays on your record for like 7 years. So, when that happens, future lenders see a foreclosure as a big red flag that signals, hey, high risk borrower. So, with a loan modification on your credit, it may show that loan was modified, but usually it recovers. You recover faster on your than uh, you recover faster as you keep making the payments. So, simply put, saving your home often means saving your credit from a major blow. Now, there are drawbacks to loan modifications. And so let's look at that. So, loan modifications gives the homeowners in North Carolina, it gives them hope, but it's not a cure-all. See, there are real risks and possible setbacks that you need to be aware of before choosing this path. Every borrower experiences it different, um, but certain pitfalls show up often. And a clear view of these drawbacks will help you to weigh your options with your eyes really wide open. Modifying a loan takes time and patience. The process isn't always straightforward. Even when you provide your lender for everything they ask, you still may face you're still going to face lots of paperwork. Lenders require tax returns, pay stubs, bank statements, hardship letters, and more. Missing or unclear documents often lead to delays. And the it's following up with lenders is almost always necessary. It's common for calls to go unanswered and paperwork to go missing. You just need to be prepared that working with the lender is not always easy, and it does require your persistence and your pursuit of the lender to push your process through to get to that review as soon as possible. And, approvals don't happen overnight. It takes weeks and even months for a lender to review your case. And often with multiple rounds of questions and requests for more information. So just be prepared. It can be a very frustrating thing, and you need to stay patient and calm and just continue to provide the information quickly and accurately as possible. And North Carolina laws on foreclosures and loan servicing set out certain requirements that there may be extra hoops to jump through. So just be prepared. It's not what we would call an enjoyable process. And so often borrowers feel stuck in limbo as the process drags on, just wondering when will this be over? When will we get an answer? And it can really add a lot of stress at a time when you need things to get easier. It's not harder. And with loan modifications, they like we mentioned before, it affects your credit. And it's not as severe as a foreclosure, but here's what to expect. You're going to get short-term credit dips. Most modified loans are reported to credit agencies. Your score may drop at first, especially if payments are missed leading up to the modification. Credit report notes your credit history may show that your loan was modified with future lenders can see that. And some lenders might view a recent modification as a risk factor. This could make it harder to get a new mortgage or a car loan or even the types of personal loans for a few years. And if you buy anything, buy another property or need credit soon after modification, you might face more scrutiny and likely higher interest rates than what someone who hasn't gone through a loan modification would receive. So modifying a home loan often seems like a way to save money, but there are costs that do sneak in. There's application and servicing fees. There's could be extra legal fees, capitalization of missed payments. Lenders may add overdue payments, late charges, or interest onto your new loan balance, and your payments may go down, but your overall debt does not. It goes up. And they also sometimes will adjust the amount of escrow. When you have most people, when they apply for a mortgage, they have the taxes and insurance escrowed in, added into the payment each month. And if you've gone through a loan modifications, you may be required to set up or to increase the escrow amounts for taxes and insurance, which means a higher monthly cost. Um, Always request whatever loan modification they present to you. Always request written details for any charges. North Carolina law limiting has laws limiting some fees, but not all. And then a loan modification is not a magic shield. Even if you get new terms, there's always risk ahead. Um, there's the borrowers sometimes after getting a loan modification, they fall behind again after the modification's made, and especially if their finances didn't improve or as they expected them to. Many loan modifications come with very strict rules. Sometimes it's like missing just one payment by a day can throw you right back into the foreclosure process. So after you would get your loan modification, it's so important that you stay absolutely current, never behind at all on the payments, or you will be put back in foreclosure. And you know what? Your lender will monitor this very closely because they don't want to. They want to respond quickly if you fall behind on a payment. A pattern late payments just by one day can put you back in jeopardy. So, according to national studies, there is a significant percentage of homeowners who get the loan modification and eventually face another default. So in North Carolina, this is a kickstart. Uh, the foreclosure process must move faster. There's already a record of payment struggles. Now, choosing a loan modification to avoid foreclosure, man, it is a big step, and it can offer a peace of mind, but only if it's right for your life and your budget. Homeowners in North Carolina should look at their finances and understand what the lender expects and make before they make this decision. So it's important to assess your financial situation. You want to start with a clear look at your numbers. So you want to grab your pay stubs, your bills, and any other monthly expenses that you have. Put it all on the table: mortgages, groceries, car payments, health insurance, credit cards, phone bill. No, go to your bank account. Look at everything that you spend money on. It'll help you to cut certain things out of your budget, but don't cut too much because if you're going to be spending money on them anyway, you need to check what your income is each month after taxes, and you want to add in all the sources, not just your main job. You want to include your bills, your mortgage, your insurance, anything that's variable, food, gas, entertainment. Subtract your total monthly expenses from your total monthly income, and then look at it. Do you have money left over, or does your spending, is it higher than what your income is? Check your savings. And also, when you're doing your budget, when you're looking at your expenses, you ought to put a line item in there for savings. You should be putting some emergency money aside for the unexpected things that happen, because obviously we know unexpected things happen. And having just, no matter how much you put away each month, doing so may save you from missing that one payment that would throw you back into foreclosure. And you know what? Don't just look at your present situation. Look at your current, look at what your, is your job secure? How secure is it? Is your income source secure? If you're really on that borderline of risk, um, you're only going to harm yourself more by ignoring that risk. And that kind of risk may be a reason not to do a loan modification. So, loan modifications, they really do bring hope and caution for North Carolina homeowners facing the foreclosure. The benefits: keep your home, lower your payments, maybe, not likely, and protecting your credit. Those are real, but the process can be confusing and slow. Some risks, like higher long-term costs or the chance of falling behind or lingering, even with the best intentions. Taking the time to review your finances and making the right decision that can help you live a better life today and down the road. If you're going through this, listen, you're not alone. Learn everything that you can about foreclosures. Get good advice, good realistic advice. Be, like I said, be realistic about your budget and your finances. Give yourself the best shot at a fresh start. Now, I want you to feel free to reach out for more valuable information that we have available to you on our website. It's www.foreclosuresolutionsnc.com. When you go there, if you want to schedule a consultation with us, just click on the contact us button, and we'll reach out to you, and we'll schedule a time to have a thorough review of your situation and really give you insights and help you know the best pathways for you to move forward on. There's also, look at the blog tab on our website. I have provided tons and tons of valuable, real information that is a kickstart for your learning while you're in the foreclosure process. We're available here to help you. I thank you so much for taking the time to watch this video. If you'd be so kind as to click the notify you and subscribe and follow button, you'll get notified every time we put out new valuable information like this. Thank you very much and have a great day.